We have an agenda, and if you kind of flip to that agenda, we're going to talk about an overview. I'll talk just very, very briefly on asset protection, why it exists, who needs asset protection. We're going to kind of carry a real-life example through, and each of the speakers will talk a little bit about it and what they would have done differently than the real-life example that I'll give you in a couple of minutes. Everyone needs asset protection. And you know, somebody asked me a question. She says, well, you know, I don't have a lot of assets. I said, do you own a home? They said, yes. I said, do you have kids? Yes. Then you need an asset protection plan. Okay, because as soon as you put that 17-year-old behind the wheel, the liability increases, potential liability increases. Everyone needs asset protection to some degree. It is not about hiding or concealing. It's about using the existing laws to protect what you've worked hard to get. Chris and I can tell you stories all day where we get a call from someone and they say, oh, my son had a boating accident. I want to put everything in my wife's name. And it's a day too late. Cardiologist puts ownership of property. This is a rental property, all right? So it's a business. Rental property in his wife's name. Think it is an effective asset protection strategy. Well, if I get sued for professional liability, then that house isn't in my name and I can't take it, okay? $3.5 million home owned by the spouse of the cardiologist, no mortgage, insured for its replacement costs, and $1 million of personal liability. He thinks he's protected. Think it through. So who's going to get, he doesn't get sued. What if he doesn't get sued, but she gets sued? Then the asset's gone. So we're going to ask each of the speakers to kind of address what might have been done in advance in order to help that.
The whole concept of insurance is what's called indemnification. It's supposed to put you back to where you were before something bad happens. You have a bad accident, your house burns down, you're supposed to be indemnified. You're put back to where you were before the fire. You're put back to where you were before the accident. Now, one of the key things about asset protection, the most important kind of insurance for that is what's called liability insurance. Liability insurance is what's covering you. It pays other people for your negligent acts. And it's part of almost every policy that you buy. So let's talk about some basic policies. 80% of large lawsuits come from car accidents. So you need to have enough liability coverage on your vehicles because that's the most likely place that you're going to be getting sued from. That's a situation where having an umbrella is necessary to protect you. Okay, now there's something else that you get with a home insurance policy. It's not everybody's policy. You should check for this. There's a concept called personal injury on property policies. It is not the same thing as a personal injury lawyer or personal injury in auto insurance. This covers you for civil lawsuits. Civil like how, you're going to say? Did somebody say that?
Civil like how?
Like how? Well, for example, slander, libel, defamation of character, wrongful eviction. If you're a landlord and you get rid of somebody and they're going to take you to court, covers you for that. Invasion of privacy. You get a hotel room key given to you and walk in and find somebody in a state of undressing. You can be sued for that. You can be dragged into the suit, as ridiculous as it sounds. If you do not have that coverage on your home policy, you got nothing. Umbrella's not going to help you. It's not going to step down and say, well, we'll give something to you. You're basically going to be running without a net in that case.
Keep in mind, though, that if you have an LLC, you're still responsible for the people who you supervise. Right? So that if you are a principal in a limited liability company practice and you're overseeing others, it's possible that you can have liability for their malpractice as well. You would like to keep those assets separate and not titled in your own name. I've seen it so many times that people will have an investment property, they'll say, so I'll have it in my name, I'll have my insurance. An LLC is like the cheapest insurance you can buy. What is asset protection? Everybody thinks of trust. They think of an asset protection trust, whether it's in Belize, Cayman Islands, or the 17 states in the United States now that allow for asset protection. Of course, New Jersey is not one of them. But what you really have to look at is asset protection is many different forms of protection. Part of it is transferring your assets. The ultimate goal is that you want to transfer assets in such a way or configure your portfolio in such a way that it's not subject to the claims of creditors. But it's not only having an asset protection trust. There's a lot of other type of planning involved. One of the most common forms of planning is holding property as joint tenants with your spouse, which is called tenants by the entirety. Because there's two aspects of every lawsuit. First aspect of every lawsuit is, are you liable, and what is your responsibility, right? That you had the car accident, you were 51% liable, and there's an X million dollar judgment. What happens if I'm a little bit older than my spouse, if a creditor gets a judgment against me, what happens is that if I die, that property, joint tenancy is a fancy name for joint ownership, joint tenancy. So if I die, my wife becomes the sole owner of that property. What's my creditor's interest? My wife must want to kill me a few times anyway, but this is an extra incentive. Okay, and we'll do one more. So in New Jersey, not only is the joint tenancy continue while the property is held, but there's a court case that actually says that if the property is sold and the proceeds are segregated in a joint account, they keep their protection as joint assets. Wow.
That's pretty powerful.
Pretty powerful. So there's always a concern, if you sold the property, could your creditor claim half of the proceeds?
That's really...
In New Jersey, that's not the case. There is a case that says that's not true. Bankruptcy Tax Act, the Bankruptcy Act changed that a little bit, saying you have to live in the house for a period of years in order to fully exempt the property. But that's something that we don't have, but it's interesting protection. Okay. Another tremendous asset protection device before we get into trusts is retirement planning. Okay? Who has a retirement plan? IRA, 401k, pension, a few of you. Okay? Okay, Mark, you've done a good job educating your clients. Okay. First, there are two different laws we want to look at. We want to look at the federal laws and we want to look at New Jersey. Under federal law, pensions and 401k, pensions and profit sharing plans are not alienable, assignable during your lifetime. What does that mean? They're not subject to your creditors. Profit sharing plans, pension plans are not subject to your creditors under federal law. There are two different types of asset protection trusts. There's the trusts that are offshore, Belize, Cayman Islands, certain other jurisdictions. Then there is a whole line of, there are now 17 states in the United States which recognize some form of asset protection trust. The most popular and the best statute states are going to be Nevada, Delaware, South Dakota, and Alaska. There's something called full faith and credit. And under the U.S. Constitution, one state has to recognize the laws of another. If New Jersey doesn't recognize it, Delaware does, Nevada does, which law applies? There have been very few reported cases on this since its inception in 1997 when the first asset protection statutes came out. The ones that have come out so far have said if you haven't been abusive, these types of plans will be recognized. But this is one of the reasons why people go offshore, because they don't have to give full faith and credit to the laws of New Jersey. I do believe that these will be recognized. More and more states are doing it, and there's a protection. What I'd like to end with is that in New Jersey, we're not in New Jersey, in generally speaking, when I've done this type of speaking with someone from U.S. Trust Company, and I give a speech every year for the New Jersey Bar, 50% of all domestic asset protection trusts are not being done for asset protection. They're being done to avoid paying state income tax. There's a major loophole that is allowed under New Jersey law, that if your investments are held in an properly structured asset protection trust, that although the trust pays federal income tax at the highest level, if a person is wealthy enough and has, I guess, over $500,000 or so dollars, they're going to be in that bracket anyway. And if the trust is properly structured, distributions from the trust to you back in New Jersey are not subject to tax when the money is repatriated.
Ken, thanks. That was really, really good. Little did Ken know that the House would pass the tax law today, and you're going to go work on this after tonight, right? You can right back to the office after this, right?
But big companies that are US based, think of publicly traded US based companies. Berkshire Hathaway. Berkshire Hathaway has 95% of its income in the United States, believe it or not. They have very few foreign subsidiaries. They're one of the biggest corporate taxpayers in the country, the top 3 of them. They're going to get millions of tax dollars back in their pocket, which is probably why Chris will tell you Berkshire Hathaway's stock has run in the last 6 months, because everybody's expecting that their earnings, their PE is going to go up dramatically. So you're going to see now, even at the individual, the smaller middle market kind of level. So anyone who's operating as an S or an LLC right now, instead of paying higher rates, and we'll get to that pass-through taxation in a minute, you're going to see people revoking S elections and going back to C corporations. Because when you look at a 20% rate, and even if you dividend it out, you could only get up to 35, worst case 40 if you're in the highest brackets. But you don't even have to take a dividend. You could always just accrue and have build-up in the C corporation. Plus you have some other issues too, like right now, S corporations, LLCs, are unable to deduct their fringe benefits wholly to 2% or more shareholders. That doesn't apply to C corporations. So who has a group of like, I don't know, 15 or 20 doctors, and you guys are paying your own health insurance, and you're a 2% or more shareholder, you're getting taxed on that, and that's a big number. I know my health insurance is about, what is that, Steve, 30,000 a year. How about the idea of not having to pick that up into income and have a full deduction at the C corporation level? So there's going to be these little add-ons that are going to go along with this choice of entity idea.
People should be frothing at this rate.
Frothing?
Yeah, frothing. Wow, this is a good one.
Other kind of hidden gem in this is the one problem with C corporations historically has always been the double layer of taxes. Someone buys me out later. Very rarely do they buy stock. They're going to buy your assets. So you have this big asset disposition, tax at the C corporate level, and then you get the money out and you get taxed again. Well, there's a little known section, I didn't put it on the slide, called Section 1202, which is never really applied right now because nobody uses C corporations. I promise you it's going to become very relevant. And what Section 1202 does is it allows C corporations, if you hold the stock for 5 years, if you're one of the original incorporators, you pay 0 tax. None when you sell it. So that's going to become an extremely relevant section here. So this whole choice of entity thing is really, I actually call it the Accountants Full Employment Act, not the Tax Cuts Act. Because the only, it's ironic that when you read the committee reports of why they did this fiasco, is they're trying to make it easier for people to do their tax returns. And the reality is, it is going to take away work from H&R Block and Liberty Tax Service, because they did do some small things that, people who make less than 50 grand a year probably do not need an account anymore. Now, the House bill, which again got passed today, shrunk everything down to 4 rates. At least that's what they tell you, it's 4 rates. But there's actually a 5th rate. You'll see that first bullet point at the top left. There's a 45.6% hidden rate. They don't tell you that, but believe me, it's there. And the reason it's there is they put this little provision in that says if you're married filing joint and you make over $1.2 million, we decided that we're not going to give you the benefit of that 12% bracket. So everybody else, the first 90 grand, you get the tax at 12%, and then it goes up like all marginal rates do, right? Well, they decided for some reason at married filing jointly, 1.2 million, you don't get the benefit of that rate increase anymore. So they're taxing you at 39.6, and they're hitting you with another 6 points on it, taking away the rates. So that's actually a higher rate than anybody pays right now. So it's a little bit off-key for them to say everybody's getting a tax cut. Not quite. So you'll see the affordable care taxes are seemingly here to stay. Now, these slides were done about a week and a half ago, okay?
They're already out there.
They're outdated. So yesterday, Mitch McConnell in the Senate, for some reason, decided he wanted to get the $2,000 penalty for those who don't get health insurance jammed into this tax bill, which I'll explain to you is probably a mistake. So there is the minimum insurance penalty that's still there, but or is going to come out if Colin gets his way. But the 3.8% quote Obamacare tax on your net investment income is here to stay. Under the regulations on Lincoln Exchanges, if I have a Taco Bell and my partner Steve has a McDonald's, I can actually take my McDonald's and his Taco Bell and we can swap it and not pay a nickel in tax. Because I can qualify that whole transaction as a like-kind exchange. Not just the real estate, but the equipment, everything that was in the business I could do. That no longer can happen. We're stuck with the 1031 only applying to real estate going forward, which is still probably one of the few things in this entire act, 430 pages, that the real estate industry actually got out of this. Because the real estate industry, frankly, lost the lobbying war in this, as did life insurance. So, oh yeah, we'll get to some more points. So as we said before, the alternative tax has gone through. So for those of you who know what the AMT is and you feel that pain, you should be very happy. So that's something that I was certainly.
But what's the?
So it's just going away?
It's going away. AMT will be gone.
How do we get screwed?
You're not getting the deduction anymore. So normally most things that put you into AMT is that you had high state and local income taxes and real estate taxes. So you'd have those deducted up front, but then the AMT would add them back. Here you're getting back to square one. You're not getting a deduction, there's no AMT. So it's a wash. That's basically what it was. It should be a wash, pretty much.
Those two.
Yeah, in theory it should be a wash. The first one, you don't see in practice that much anymore because defined benefit plans, for a lot of reasons, they can be expensive from a funding standpoint. There's a liability attached, it gets a little crazy. But where these still come into play, I'm sure Mark, you do these too. I get a lot of executives as clients. So for instance, I have a client that used to be the CEO of Krispy Kreme Donuts. When he retired, he got a severance, and a lot of these guys and gals that are former executives and CEOs of public companies, you know what they do in retirement? Board seats. They're on boards all over the place. And they do silly consulting jobs and get paid a lot of money to do consulting. I always find it funny when I see a CEO who buried a company and somehow gets hired to do a consultant, but it happens. So I had set up a defined benefit plan for this particular client because now he had board seat income, which is self-employment income, by the way, and he had other consulting income, and he was by himself. Most executives in these companies are not young. You know, they're usually in their 50s or higher. So we set up a defined benefit plan for him. And in 1 year, he had consulting income of about $600,000 net, and we were able to put a defined benefit contribution of $210,000. Well, $210,000 is almost 4.5 times what you can put in a defined contribution plan, a 401k and whatnot. So in the right circumstance, when you have older owners, and you really got to get your TPA in, the third-party administrators, you always want to analyze whether bringing a DB plan, defined benefit plan, back to life makes sense. Now, as an alternative to that, we have a cash balance plan. Okay, now, cash balance plans are really coming back in vogue. Same kind of group. You want that demographic of partners that are a little older with younger people underneath you, okay? The benefit of this is it kind of works like a defined benefit plan. You're trying to shoot for this maximum retirement amount for each person, but there's no funding liability. If it goes bad and you start losing money and you have profit, you can wrap it up and roll it out to IRAs and not really have too many problems. So in the asset protection world, as Ken and Rocco both mentioned, you can have really significantly high balances in these qualified plans, and no one's going to touch them except the IRS, which can. And there are ways to fight them too.
I really appreciate all of you coming, giving your time. I apologize for the traffic, can't help it. But this is just part of a series. We will have another series in the spring, which we'll keep everyone abreast of. We would love you to fill out our evaluation form. It is part of the sheet. Just go to SurveyMonkey and fill it out. Tell us what you liked, what you didn't like, what you would like to see in the future. And we're happy to bring these things. We've been doing this since 2006. We're going to keep doing it. That we keep providing education to people, and you know, our clients show up and non-clients show up all the time. So please, you'll get plenty of press on it.